Well, I'm Paul Hefner, and I'm doing a video on finances for the Regis Innovation Challenge. We are right in the middle of the COVID-19 stay-at-home thing, so we're going to do a video, and we can follow up with questions and things like that if you have any questions. Here's an agenda. Um, Basically, these are the questions you should think about. If you want, you can pause the video um, and think through these. The first one is, how much money do you need? There's a hint there around thinking about your revenues and costs, and this whole section will focus around pro formas. The next section will be, what do you need to prepare for taxes next year? And this section will focus all around bookkeeping and getting everything ready. The very last section will be how you're going to fund your business. So here's an example pro forma slide. There's a lot of numbers and things on here. I'll start with the most important thing, and I would say that that's making sure you have some sort of forecast of what your revenues, your gross profit, and your net income is going to be in this sort of section right here. There's a few things I'll call out that you can add or not add depending on sort of where your business is and what's useful to you. I would say that a formal pro forma for getting funding and that you're going to show to investors would definitely have a detailed income statement, balance sheet, cash flow, statement of cash flows, and some sort of variables and things in here you can play with the assumptions. We'll cover some other stuff in the pro forma as well. Some other things that I like to do in my pro formas is to have some sort of scenarios or variables you can play with. This pro forma was for a brewery, and they were trying to look at two different things. One, it was launching a production facility, and one was opening a second tap room. And so this sort of scenario sort of says, if they open the production facility before they open the tap room, then it ends up being a huge waste of money because they make all this beer, but they don't have any of the demand to sell it, so they end up with excess inventory and extra cost. Versus if they open the second tap room first, then they'll have more sort of revenue because it takes time to ramp up the second location as well. But that's not important. But what's important is you can run these scenarios and do different things, and this is really useful for pro forma. Another thing to call out here is all these sort of ratios here. So one that's really important to me, well, I guess first is your year-over-year revenue growth. So when we get later, we'll talk about believable pro formas and things like that. This is sort of more of a not a high growth startup business, but even still, you should be looking at these ratios. Another good one is the operating percentage as a percentage of revenue. This is where a lot of your employee costs and things will come through. And so something that you can sort of see here where it's getting better and better and dropping as the years go on. But a lot of times when people are doing their own pro formas, they basically say they're gonna hire 5 or so employees and they never hire anybody else, and then they're out $1 million company a few years out, and they're still saying, hey, we only have these 5 employees. So it shows that they have really low operating percentage of revenue. And this one here, one of the questions we're trying to answer here is how much cash you need. We'll come back to this, but you can see here the cash balance is actually turning negative. So this would come from your balance sheet, which will be driven by your statement of cash flows. But in this scenario, it would say that this company needs to raise more money based on the current levers. Obviously, they can change when they launch the production facility or when they launch the second tap room, as and other assumptions to change that as well. But basically, that's one of the main outcomes of the pro forma. So one of the questions that people always ask is sort of how aggressive to be. So there's this idea of conservative estimates, and sometimes people will send me over their financial model, and it'll have 3 different spreadsheets. They'll have a good version, a better version, and a best version. And they'll sort of say, hey, what do you think about this? And the truth of the matter is that you really should probably have one pro forma, and it should probably be your best guess on what you're going to do for your business. I have the picture of Goldilocks here. You don't want it to be too aggressive, and you don't want it to be not aggressive enough. You sort of want it to be right in the middle of what you're really planning to do and really use it to run the business. And that's what you should be sharing with investors. there are times, not necessarily in a good, better, best scenario, but you may have different versions where you're showing a certain version to your board, a certain version to your employees, and certain things like that. So you can definitely have different versions, but I think this idea of conservative estimates is pretty funny. I think everybody thinks that they have these conservative estimates in here, but they still have tons of revenue. And I guess the stat here is that most of the businesses go out of business within 5 years. Common mistakes. The most common one is not believable. So there's the idea that you can have a forecast that's probable, or one that is likely, I guess. So this idea that you're going to make $1 million in your first year, or you're going to be a unicorn, $1 billion in 5 years. It's possible, but it's not probable that they're going to do that. So when I see those numbers in terms of revenues, it sort of makes me step back and say, did they really think through this, or there's some things that I should look at to see where these numbers are coming from. The next one is the revenue growth assumptions. We'll cover that on the next slide. Anytime I see a pro forma that says, revenues are going to grow 10% every year, or they're going to grow 10%, every month, or something like that, but there's no real drivers for how they're getting customers or how they're growing revenue. To me, that's not a very valuable pro forma. It's just, basically they have an idea that they're supposed to hit a certain number, so they just played with those, revenue growth numbers until they hit it, and it's not really an accurate plan of how they're going to run their business. The last two are sort of go together. We talked about the employee expenses, where sometimes they don't keep hiring employees for the out years, and that would show that the expenses aren't growing with the revenue. And the other thing that can happen either way is you might end up with a lot of EBITDA or cash in those out years, and there's one is because you don't have enough cost because of employees scaling. The other one is that if you really had that extra cash, you would invest it back in the business and more growth. You would hire more salespeople. You would do other things to continue to grow the business. There's not it's not a wise investment to sort of be sitting on cash, regardless of if you're bootstrapped or VC backed. Here's just two funny pictures. Obviously, this picture here shows the inverse hockey stick, so it shows the revenues leveling off, which is a pretty bad scenario. It basically shows you sort of stalling out and no growth, and especially if you're trying to sell the company, those revenue multiples very much factor in what the growth rate is. So if your growth rate is slowing down, you'll get a much lower revenue multiple, and that's something that other people are going to look at as well. So what's your growth multiple? And then here's the traditional hockey stick, which tends to be pretty accurate. Your revenues don't really go anywhere for the first few years, and then obviously it grows more than flat, but then after you're out a few years, then it really goes up if you're doubling or tripling your revenue every year, if you're sort of a high growth startup. Here's a slide on the revenue assumptions, and this is the first question I ask every company that I work with when I'm looking on the performance. I say, how are you going to get customers and revenue? There's some pretty easy ways to do it, but really you should have a clear plan. It's either going to be through marketing, or it's going to be through sales, or some combination of the two. So a lot of times people will be advertising through Facebook or Google in terms of marketing, or they'll be doing some sort of sales, where they have sales reps, they're going to conferences, or they're calling customers. They're doing all those things to try to get additional customers. Ultimately, when you know how you're getting the customers, then you're going to calculate a cost to acquire and the lifetime value. I try to look at these. I like to have the lifetime value to be at least four times as much as the cost to acquire. So in this example over here on the right, in month one, it looks like they're acquiring customers for $250. So I would want to see $1,000 lifetime value. This chart doesn't get into lifetime value, but so they would want to basically be a customer for 4 months, and then that's the point they would break even, and then anything above that, they would what am I trying to say? You want that to be 4 times as high your lifetime value. Another mistake is sort of trusting that low hanging fruit. So a lot of times customers or companies will just start out and they'll send off an email to their whole network saying, hey, we just launched, check us out, sign up for our first product. And they'll get, a bunch of friends, maybe they get their aunt to get, a few people sign up and say, this is great. We just got 3 customers and we didn't do any marketing yet. This is going to be an easy business. But what they don't realize is they've, sort of just exhausted their network and they've got all the easy customers. And to really have a business, you need to know how to keep scaling and not just get those easy customers, but how are you going to, if you got 3 customers this month, how could you get 6 customers next month or something like that to continue to grow, and continuing to email your network or doing whatever else isn't going to do it. And the last reason to really, have these drivers, I have this example here where they're getting customers through, marketing by advertising through Facebook or Google and sending people to the website, or through going to a conference. And so you have these ideas of, what it's going to cost and how many customers you're going to get. But when you start running it through the month to month, you'll really be able to say, hey, I thought I was going to get 2 customers this month, but I spent all this money and I didn't get those customers. And you can say, okay, well, we're getting more customers through the conferences than we are through the website. Why don't we stop the website or the marketing spend and focus more on the sales spend, or back and forth. So you sort of know when to pivot, especially if you have an idea, because you might have some things that take longer, because maybe these conferences, you have an idea of when they're going to do, but maybe you don't get a customer from the conference until 3 months later. So if if you're running this and you're not planning for it, you very well may say, hey, these conferences are crap, we're not getting any customers. You may stop it in the 2nd month when really, your customers are going to be coming in that 3rd month, and then all of a sudden you've stopped going to conferences and not continue to grow where you thought it was going to be. So there's a lot of reasons to sort of have a plan and really do this, versus just saying, hey, our revenues are $4,000 the first month, they're going to be $9,000 the 2nd month, and not really having any of the drivers behind how you're going to get there. On the cost side of the Proforma, the COGS and gross margin are all driven off of the revenue. So those are sort of straight percentages. Obviously you can get some improvement as you get economies of scale, but for the most part, those are pretty easy to model out, unless you're doing big things to sort of change those over time. Staffing is sort of the hardest part. It's really who are you going to hire, how much you're going to pay them, when are they going to start, and figuring out how they're going to scale with revenue and what sort of efficiencies you might gain. In my mind, you definitely, especially for the first year, but even further, you should definitely plan when you're going to hire all those people. So what date are you going to hire the first sales rep, what date are you going to hire the second one, when are you going to hire a director of those, or a VP of marketing or sales to sort of oversee those people. When are you going to start hiring on your development or IT side, if you have that, and all of the other administrative costs as well. So when might you hire a bookkeeper or CFO or something like that? On the sort of operating expenses, the rent, marketing, all those things, a lot of those, when we're looking at that first slide, the OpEx as a percentage of revenue, those will all grow either as a percentage of revenue or as a percentage of employees. So you can sort of model out those. And the last sort of cost to think about is what are your one-time costs or startup costs versus sort of ongoing costs. So if you have a bunch of legal fees to file and get started for patents, or to launch your product, a lot of one-time marketing and things like that, you might want to capitalize some of those costs. And maybe not as much marketing, but definitely the legal or any sort of development costs can be capitalized. And so then when you're looking at your financials, to more show sort of what your business is doing and not just this huge investment and sort of a one-time thing. And especially if you have debt or other things, you might have leverage ratios and things like that. So then it's super important to sort of separate out your one-time cost. So back to the question at the beginning of this section, how much money do you need? It varies, but essentially what I think you need to do is build out, what's this example showing here, what are your revenues, what's your gross profit, do the whole pro forma and then figure out what your cash flow, and you need to sort of make sure that you're going to have enough cash to cover your cash flow. So in this example, which may or may not mirror the first Proforma slide, you can see that their cash flow is sort of minus 200K for the first 2 years. So at a high level, you would say, hey, they need to have 400K of additional cash to run the business, and that's the best place to start. There's some other things you can think about if you're getting funding and things like that, and we'll talk about that a little later. So the next part is all around setting up your bookkeeping and getting ready for taxes. These are sort of the basics of what you need to do. So first, you need to register your company, get your employee ID number, register with Colorado Secretary of State or wherever you're located. Open up your business bank account, which you need your those numbers and things set up before you open up your bank account. I recommend getting a credit card. I'm a big proponent of getting points and things like that. So you might as well get a credit card whenever you can. Use the credit card for expenses. And then the reason you want to set these up is you want to keep all of your business and personal expenses separate. It just makes accounting a lot easier, and you don't have to go back at the end of the year. And it's always just really tricky, and sometimes it's even hard to know, is this a business or a personal expense? And if you're making that decision to say, hey, this is business expense, then you make sure you charge it to the business account and keep it separate. You also want to track up an accounting system of how you're going to keep track of everything. I like to say, starting out, Excel is fine, but there should quickly, once you become a real business with real customers, or you're trying to get funding or trying to do other things, then you really need something beyond that to track, all the different expenses and all the different things going on. There's a bunch of systems laid there. QuickBooks and Xero are probably the two most common. And then once you really want to start managing your business, and once you're going to say, how did we do last month, or how did we do first quarter, all those things become a lot easier when you have some sort of a system in place, and it just becomes more automated the more and more you do it. The next question is figuring out how you're going to get money from customers. So the most basic way is you can send an invoice out of Word or Excel and say, hey, we did 4 hours of work, or hey, we delivered this product. You owe us $100. If you use QuickBooks or Xero, then they will send invoices out of there. And then there's some other ones that, and they'll process credit cards as well. Then there's some other, if you're doing direct to the consumer and you have credit card processing at sort of a retail shop or something like that. Square and Shopify are pretty common. And then the last part is figuring out how you're going to pay yourself and your staff. So there's, if you're an LLC and things like that, you can just pay yourself through owner draw. But as you move into S Corps and C Corps and things like that, you need to start paying yourself on payroll. And then if you pay any contractors, you'll need to track how much you're paying them. You need to collect all their W-9 info, which is basically their social security number, so that you can hit their 1099s out by January 31st, which is always a big shock for people when they don't realize they have to send any forms out besides their own taxes. So make sure you're keeping track of that and getting their info. And so here's the bookkeeping 101. This may be pretty basic for some of you, but for those of you that are just starting out, I wanted to at least have one slide that basically explained bookkeeping, which is really taking all those charges on your credit card, all the money that you made in revenue, and then being able to translate that into a profit and loss and a balance sheet statement. And then, like I said, a lot of these things will have different rules and things. Then next time you go to Starbucks, it'll know that that's a meals and entertainment expense and all those things. So there's some things that you can set up and make it easier and easier. But that's basically all bookkeeping is looking at the historical piece of what you spent and what money you made, and then classifying it into a financial statement. So some common mistakes on the bookkeeping side. I think surprisingly the most common one is that people will be running their accounting software, QuickBooks or Xero, or whatever other system they're using, and the software will say, hey, you have $10,000 in your bank. And then you open up their bank account, look at the bank statement, and they only have $2,000. And then so that they've missed $8,000 of expenses in that example, and so something is wrong in the books. Another one is if they write a lot of checks, not keeping track of who the payee is. And And so, obviously you're going to use that for 1099s. Another mistake is credit card payments. So a lot of times, what'll happen is when they pay the credit card, say the credit card has $1,000 balance and they pay it, if you do it incorrectly, you'll basically show $1,000, from the payment coming in. But then when you do the transaction from your bank, you'll say, hey, we paid $1,000. You'll send another $1,000 to the bank or to the credit card on file in the accounting software. So now it looks like you have $2,000 paid. So there's a lot of double counting that happens if people don't do that. So the way you have to do that is you really have to do a transfer and then match that payment. Another check from sort of auditing and taxes is looking at when you do your payroll at the end of the year, there's a 941 form that goes out, and it shows basically your salaries and taxes and all those things, and then those should match the amount of payroll taxes and salary that you show in QuickBooks. So that's an easy check for somebody to check. If they don't match, it's sort of a red flag. Another thing is depreciation. So a lot of times I'll see people, depreciating things that are $50, which you can do, but it's just, a lot of extra work to keep track of it. So I like to have some sort of policy on what you should do. Unless there's a reason, I usually say, everything over 2,500 should be, or 2,500 should be depreciated, and anything else can be expensed. And then there's also the depreciation schedules. A lot of times we use the Macker's acceleration, because then you get to accelerate more of it. But then there's other things. Like I said, if you're trying to have financials paint a certain story for investors and things like that, you can do different things, especially around development costs and things like that. There's a lot of things to think about there. Balance sheet accounts with a negative balance. So you might have some account, and instead of showing, hey, you have a $1,000 balance, or show minus 3,000, and usually that either means it's misclassified between an asset or a liability incorrectly, or something's gone haywire and it's not updated. Let's see. This isn't quite bookkeeping or related for taxes, but I always like to say something that most businesses that are starting out or at any stage need is some sort of weekly cash flow to get an idea of how cash is going to come in week to week. Because really, if you run out of cash or you're not planning for something, you can easily get in a situation where you're missing payroll or you're doing something bad. So I like to have some sort of thing. This is just an easy one. It's looking at the accounts receivable and accounts payable, but there's lots of ways to do this. And I'm actually thinking about doing a video and posting it on my website here in the next week or so, because with the current coronavirus, a lot of companies are sort of forcing or facing a cash situation. So I think this is a pretty easy thing to learn how to do. So what do you need to do to prepare for taxes next year? Basically all the things we just went through. You need to set up your accounting system, you generate those financial statements, issue the 1099s in January. If you're a product company, you need to do quarterly sales tax, which we didn't talk about, but that's something you need to set up within your accounting system and keep track of that. And then a lot of times you'll need to work with a CPA to actually file your taxes. But for the most part, if you're have time, you can do your taxes yourself. But I think eventually you'll want to spend more time on your business, especially as things get more and more complicated. And then there's also the not related to taxes, but once you have this bookkeeping system set up and cash flow forecast and all the other Proformas, you can use all those tools to sort of say, how's the business doing? Are we making progress on our plan to hit whatever end of year revenue target you have, or are you running out of cash where you need to pivot and slow down, or whatever it is. You need those reports to sort of run the business. The last section is all around funding. There's basically, in my mind, 3 areas to get funding. They're sort of listed in reverse order. So the equity is the one that you probably hear the most about. There's the friends, family, and fools. Actually, I meant to update the slide, but then before that, or before the angel investors, there's accelerators and other things like that, where people will sort of buy a very small chunk of your company and give you a little money and a lot of times connect you with advisors and investors. And then we have angel investors and venture capitalists. So that's sort of the flow of how the different stages work. But the tricky part with equity is, and I'll cover this on the next slide, but it's really hard to get equity financing, and you're giving up a big part of the company, you're giving up a lot of control. So I sort of call equity financing sort of the last resort. But obviously a lot of people do it, and it gets very much glamorized in the media. But that's one. The one that not a lot of people talk about is sort of debt financing. This is basically where you get money and you pay interest on it. So you don't give up a part of your company, but you're paying a certain percentage. A lot of times for small businesses, you sort of be in that 10 to 15% range. But there's small business loans, traditional loans. Accounts receivable is basically for companies that may have a big contract. So maybe they sell a huge development project, and it's a $20,000 check for when they finish the project. But it might be 3 months before they finish it. So then an accounts receivable company will say, hey, you got that $20,000. We'll give you $18,000 now, and then we'll just keep the extra $2,000 when the bill is finally paid. So that's a good way to get cash. Inventory financing is another way. So a lot of times you can get money to buy inventory. Again, it's not quite, you're not going to get the exact dollar amount that the inventory is worth, but you'll get a certain percentage of it. And then there's sort of more aggressive interest rates like cabbage or credit cards or things like that, where you can get money sometimes pretty quickly, but you're going to pay a really high interest rate for it. And then the best case is sort of the bootstrapped. This is where you're using your own money. A lot of times you can do crowdfunding like Kickstarters or things like that, where you can say, hey, we're going to launch this product. You sell essentially all the product up front. You get all the money, and then after you sort of make it or manufacture it or do whatever you're going to do, then you ship to the customers a few months later. But you have the money up front. There's other small business administration grants and other things like that where you can get some money depending on sort of how groundbreaking your company is and what areas you're working in. So in my mind, when I think of how you're going to fund your business, like I said, the best way is sort of bootstrapping and focusing on getting customers. If you can get customers, which I think a lot of people underestimate how hard that is, or how you're going to scale getting customers. Once you figure that out and you sort of get this traction, if you do have to go the angel investor route or something like that, then the more traction you have, the better it'll be. But it also opens up more options where you can do some of the other debt financing that we were talking about. There's also more control and flexibility with how you operate. So you can say, hey, we're gonna, cash is getting tight. We're gonna slow down, or we're gonna, focus on this this different sort of channel that we haven't tried before. We're gonna do all these things that are different. You can sort of make all those decisions yourself, versus if you're in sort of the have investors on board, they're going to be very influential in what they want you to do. That is obviously the sort of in-between way, and then the equity financing. So I think another thing that people forget about is it's going to take a long time to get equity financing. I would say at a minimum, 6 months, in sort of a best case scenario, because there's people, even after you pitch, they're going to sort of do their due diligence. They're going to do some meta due diligence, which is where they're going to basically say, hey, we got your Proforma. You said you were going to do, sell 10 customers last month. You only sold one, and sort of track, how you're doing versus your forecast and how you're communicating things, and just to see how quickly you respond to emails and other things like that. So they're just trying to see if they like working with you. So that takes a few months to sort of figure that out. So in the best case scenario, it's sort of 6 months. But I've worked with some companies that it's taken years to get financing, and sometimes companies don't get it at all. There's this sort of perfect sweet spot, sort of like finding somebody to get married to or something like that. You can keep dating and keep trying. You may not find that perfect investor that is investing in your industry or in sort of your stage, and so you have to find that perfect fit. And I think it's also overlooked that, for every company that, angel investors and people are investing in, they're probably seeing 100 companies. So you have to sort of be in that top, 1 or 2%. And, especially I think of it like, some of those, investor events around town, they'll have 20 companies pitch, over 1 or 2 days. And, just the top, 5 or so are sort of proceeding to the next round. And then of those, then those are the 1 or 2 that'll get invested in. So, and some of those, CEOs have, had companies before that have, had exits. So you can imagine, somebody who comes in and says, "Hey, I've got this great idea," and then there's a CEO beside him that says, "Hey, I built this one company. I built it from nothing to $10 million or $100 million and sold it. I've got this other idea that's really similar. I'm basically doing the same thing, but I need a little seed capital to get me off." One seems sort of tried and true and a little less risky, and those are where the investors are going to tend to migrate to. You also lose control. Um, so if you are sort of taking too long or different things, investors may pressure you to sell the company. And then you also lose your equity for the payout and exit. I've seen a lot of CEOs. Well, and also they may fire you because I've seen some CEOs, sort of be 10 years into a venture, and the board may say, "Hey, you've had your run. You're not growing the company anymore. We're gonna sort of, fire you out." And they might have, different compensation packages and get paid a 1 year severance or different things like that. But a lot of times if they've raised enough rounds and they're 10 years in, they basically don't have much equity left in the company, and then they're sort of fired and they sort of lose, I don't know, lose it all. But obviously those are sort of worst case scenarios, but I think that they're often overlooked. So let's see. So yeah, I think that's it as far as slides. Based on where we are with the coronavirus and things like that, here's my email. You guys can send email questions. We may set up, Ken may help us set up a Zoom or something where we can do a live Q&A. But yeah, I hope you enjoyed the presentation, and yeah, I'm glad to help out, and I'd love to find a way to meet some of you guys or gals or team members whenever it makes sense and things sort of calm down. But I appreciate you guys watching the video, and again, let me know if you have any questions. Thanks.